Good morning and a warm welcome to all the participants to the post-results earnings call of Shaily Engineering Plastics. I hope you're all keeping safe and healthy. I have with me Sanjay Shah, our Chief Strategy Officer, Anil Kalra, our CEO, and SGA, our Investor Relations Advisors. I hope you've had a look at our investor presentation that is uploaded on our website and the stock exchange. Quarter 3 of FY21 was truly a remarkable quarter in Shaily's history, where it was the highest revenue that we have ever recorded for a particular quarter. We are confident to further build on this trajectory, given our strong order pipeline and the addition of new orders. Shaily is currently present across 7 verticals and holds a strong command over its products, coupled with long-term relationships with customers. We're growing with our home furnishings major. We've also scaled up from 18 SKUs in 2017 to 48 SKUs currently, and are further strengthening this relationship with addition of new capacities and products. Our toys business, which was started nearly 1.5 years ago with Spin Master, possesses huge potential for growth. Today, we're one of the preferred partners from India for global toy manufacturers. We are increasing our footprint in this segment and getting validation from the brands, which showcases our ability and efficiency in this very significant market. Shaily manufactured children's products comply with the highest international standards of quality, and we expect to further ramp up this business in the coming quarters. We are future ready to meet this demand. In the last few years, we have spent considerable time in developing our own intellectual property for drug delivery devices, which is now reflecting in our performance. Healthcare business earns better margins for us and should be able to grow at a faster rate. Let me briefly throw some light on the business update for this quarter. On the home furnishing side, we have received confirmation for additional business of 120 crores. On the toy side, we've added another product from our customer valued at $1.5 million per year. We are therefore expanding our Rania facility to meet new and existing projects for toys. This facility will be operational by the end of the current fiscal year. In the healthcare segment, we've developed intellectual property for an additional pen injector, and we'll have that commercialized by the end of FY22. We have announced expansions of capacity. We have started construction of a new plastic plant on our new campus in Halol. This plant will be operational in the first half of FY22 and will help us service the new orders, especially for the home furnishings major. This is all from my side. I shall now hand over the call to Mr. Kalra, our Chief Executive Officer, to give you his thoughts on the business. Thank you.
Good morning, everyone. Hope you're all doing well. Please allow me to throw some light on the operations at Shaily Engineering. In terms of the top line, we have seen significant growth of the business, and hopefully that should be maintained during the coming quarters, despite all the odds in terms of logistics that the world is facing throughout. The costs are being closely monitored in all the units at Rania and Halol, and that is given good results. We have seen significant savings in terms of power, operational costs in terms of the employee to turnover, and other cost parameters. Now, there is a team that is closely monitoring the pricing in terms of what we get from the customers and what we spend, and that kind of close monitoring is really very helpful, and I'm sure we'll be able to reap in more benefits in the coming quarters. Our technical team has been strengthened quite well to meet the new challenges of the new projects that are on the anvil, and starting from the design to the commercialization of the products, we have people with us, and they are seeing through in a timely manner to meet the targets. and the timelines. Now, the challenge lies with the carbon steel plant. I wish to inform you that there is a positive news on that account. Carbon steel plant, which was commissioned in December 20, has started producing articles, and we have had already 3-4 times the third-party inspection of the customer, and the products have been dispatched. This month would see some growth in terms of the top line, double of what we have seen so far in the previous months. And hopefully by this year end, we would have commercialized 3 major articles out of the 5, and that should take up the top line well, and also that should be a significant there should be a significant improvement in EBITDA due to carbon steel plant. As Amit just mentioned, that there are new projects that have been offered to us by our existing customers and also toy business. So the operations team is now fully geared up on commercializing the toys business. The sales should start towards the last end of this financial year and pick up in the first quarter of the next year. And also the Halol plant, which should be commissioned and support the plastic business of our major customer. With this, I am handing over to Mr. Sanjay Shah, our Chief Strategy Officer. Thank you.
Thank you, Mr. Kara. Good morning, everyone. I shall share with you the highlights of our operational and financial performance for Q3 FY21, following which we will be happy to respond to your queries. During the quarter, we processed 4,400 tons of polymers as against 3,599 tons in Q3 FY20, which marks an increase of 23% year-on-year basis. We are gradually increasing returns by efficiently utilizing our facilities. Machine utilization rate was 70% in Q3 FY21 as compared to 66.5% in Q3 FY20. Exports during the quarter stood at 75% of total revenue as compared to 69% in the same period last year. For Q3 FY21, our revenue stood at 105.5 crores as compared to 88 crores for the same period last year, growth of 19.6%. On a year-to-date basis, we reported 250.8 crores of revenue as compared to 256.4 crores in 9 months ended FY20. EBITDA for Q3 FY21 is 18.9 crores as compared to 15.5 crores in Q3 FY20. EBITDA margin stood at 17.9% in Q3 FY21, 30 basis point improvement over previous year same quarter. It is important to note that EBITDA margins in the current quarter were lower on account of lower MES benefits post the recent capping of MES benefits by the Government of India. Net profit stood at 8 crores for Q3 FY21, a growth of 27% year-on-year. Cash back for Q3 FY21 was reported at 12.8 crores as compared to 10.8 crores for the same period last year. For the period, we incurred a capex of 15.53 crores, and we expect further FY21 capex to be in the region of about 20 crores. The capex spends for Halol and the new Rania facility for toys will be 70 crores, and a large part of it will be spent in Q4 FY21 and Q1 of FY22, allowing us to be ready for commercial supplies by the end of H1 FY22. With this, I would like to summarize on our operational highlights front and let you know that we are all working actively towards diversifying our business model, and you will see better trajectory in quarters to come as new orders start commercializing. That is all from our side. Now we can open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Hitesh Tang from ICICI Direct. Please go ahead.
Thank you for the opportunity, sir. And hello. Thank you for the opportunity, sir. And congratulations on a very good set of numbers. As far as top line is concerned, we have recovered on a 9-month basis. Sir, I have some questions on the recovery front. Like we have seen a good top line growth during this period, and but nearly 60 to 70%. What I can understand from our previous calls also that 60 to 70% revenue comes from the overseas market. So, sir, I just wanted to know our business, has not had any impact of second wave of, or lockdown in the overseas market. What we have been continuously, seeing from the media report that the second COVID impact, the second COVID, lockdowns were there, and but we haven't seen any kind of impact on our top line. So, any specific reason, sir?
The second wave impact has been there, and we wouldn't say that it hasn't been there, but it will be. So we've had lots of challenges on the logistics front. We've had lots of challenges on availability of materials, and some challenges on even fluctuating forecasts from various customers for various regions. Overall, the business, however, has done exceptionally well, especially in a lot of the markets where the lockdown or the second COVID wave hasn't really impacted the market that badly. There are some markets where we are seeing volume drop, but it is being covered up by another region, and also being covered up by the additional products that we added and the new business that we had developed over the last.
So if we compare on a like-to-like basis without adding our, the new product category, so was it a good recovery there in that? If you compare like-to-like, is my understanding is correct that the existing product category would have a kind of a growth only and not decrease?
Yes, Hitesh. The existing products have also seen growth. So.
Okay.
Compared to last year, also as compared to quarter 2.
Okay, great. Sir, my second question pertains to our gross margin. Though sir has explained a bit supply concern and all. So I just wanted to understand our gross margin was kind of under pressure during this quarter, despite having such a good volume jump, and the changing mix also towards the healthcare category, which is a kind of higher margin business, what we understand. So, is this a one-time event, or we can see kind of improving gross margin going forward, given the fact that our new capacities will start, giving a good utilization level going forward?
So, Hitesh, there are two things here. When we look at gross margins, I mentioned in my speech that MEIS has been capped based on the 2 crore limit which the government of India has set, which has impacted our gross margins. We commercialized carbon steel in quarter 3, December to be precise. So from a gross margin level, the contribution from carbon steel was lower. So these were 2 reasons why you have seen a little minor drop in gross margins. We expect that gross margins to go back to normalized levels as we move forward in the quarters to come, and probably improve. So that's okay.
Okay, great. So my last question, pertains to our annual revenue opportunity, what you have been guiding since Q1 FY21, during the challenging period also. So, the new business opportunity in the toy segment and the additional, you can say, orders from the existing home furnishing measures. So it is safe to assume, sir, around 200 odd crores of revenue opportunity what is lying for to execute in FY22? Additional, I'm talking.
We have given the numbers in terms of what additional businesses which you have added in Q1, Q2, Q3.
Right.
And if I were to look at that, the number adds up to higher than what you are saying. So that's the type of opportunity which we are looking at here.
But sir, opening remarks we had, in opening remarks we have been mentioned our carbon steel project is will be fully operationalized from current year, and that too from I think December or November of second half of the year, right? CY I'm talking. So if I exclude that much of revenue, then it would be around 200 crore, or it will be more than 200. That's just confirmation.
No. He's talking excluding carbon.
Okay.
The new businesses which we have talked about. So, Hitesh, the 200 crores of the number which you're talking about is on an annualized basis. Some of these projects are getting commercialized Q1 and Q2 of FY22. So that's something which you need to take into account, and then there will be a ramp up which will be done.
Okay, sir. I have few more questions. I will come in the queue, sir. Thank you.
Okay. Thank you very much, Hitesh.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Ravi Naredi from Naredi Investment. Please go ahead.
Thank you very much for giving me chance. I would like to know, in next 1 year, from which sector are we seeing good revenue in company? Carbon steel or other old verticals?
So Ravi, I think we are looking at growth across different segments, whether it's home furnishing, whether it's steel furniture, whether it's toys or healthcare. We are looking at growth in each of these verticals in the coming year, in FY22.
Okay. And sir, what is our debt at present, and how much new capex we are going to do so, and what will be debt after 1 year?
So the total capex which we are going to do, additional capex, I just mentioned in my speech that for the toys and the new plant which we are setting up in Halol will be in the region of about 70 crores, for which we already have funds which have been tied up.
But we will raise the debt or equity?
Oh, so it will basically be funded by a mix of debt which has already been raised and internal cash accruals which we have. We are not looking at raising any equity.
Okay. Thank you very much. All the best.
Thank you, Ravi.
Thank you. The next question is from the line of Vikas Khemani from Carnelian Capital. Please go ahead.
Hello, sir. Good morning. Congratulations on good set of numbers. Couple of questions. I think in the scenario of the rising raw material prices, how does we stand?
Repeat, your voice is breaking a little bit.
Sure. Is it better now, sir?
Yeah, a little bit.
Okay.
Yeah.
So my question is, in the situation of rising raw material prices, how do we sort of handle? Is this mostly pass through, or it happens with a lag, or how does it work? That would be good to know. And secondly, I think we hear that lots of restrictions are there right now. Lots of constraints are there right now because of the container unavailability. So when do you think this situation should normalize, and do you see an impact of that going forward? And the third question would be, if you can get some sense on what if tomorrow the rupee starts appreciating? I mean, do we have any sort of I would love to get a sense of pricing mechanism.
Okay, so on the iron pricing, because it's a pass-through with a lag of 3 months.
Okay.
Right. So it is always with most of our customers. It is previous 3 months average pricing, which gets applied to the following quarter. On logistics, we have seen improvement between December and January on the logistics front. We are seeing some improvement right now. I wouldn't say significant, but we hope that it normalizes by Q1 or end of Q1 FY22. There really isn't a way for me to really gauge when it will normalize. Typically, we see shortages of containers during Chinese New Year because whatever hasn't gotten out from there doesn't get out until 18th or 19th of February.
Mm-hmm.
But so far, we've been managing logistics fairly well. And I'd say even though there are shortages, we should not get into a position where we are unable to ship product.
And what kind of cost rise we would have taken in the last recent quarters in terms of our logistics cost? I mean, I'm sure there would be high cost, right?
So there are two things there. In most of our cases, in terms of exports, our pricing is export. So the cost gets borne by the customer.
Okay.
We would have seen marginal cost increases on our raw materials because of logistics. So, but then there will be margin.
But that also is, again, same principles apply. On landed price, as a pass-through.
The third question was on rupee appreciation. So if rupee appreciates, because a lot of our revenue, especially to the home furnishing major, isn't actually in rupees.
Mm-hmm.
So for us, it becomes a neutral thing.
Okay. And other question I had on the capex side, how much? I mean, so first of all, I mean, this current year, FY22, how much of the capex we are operationalizing, and same thing for 23, how much capex we'll operationalize?
So we just capitalized the steel furniture facility, which was a total capex of about 55-57 crores, so which is what was commercialized in December of 2020.
Right.
We will be commercializing further capex of about 20 to 25 crores in Q4 of FY21.
Okay.
But then if you were to look at it, on carbon steel, a lot of it was spent during last year, which is getting commercialized now. So that's something which you need to be getting in mind. Yeah, 1920.
And the next year, sir? I mean, in FY23?
So
FY22, my fault. 22, sorry.
In this case, we would be spending about 70 crores on the new toy facility and the new plastic facility which we are creating. Right. Yeah. So toys will be done in the current year. The new facility in Halol will be done in the next year.
Okay.
So that's how we think.
And is that the normal capex we should assume, even let us say if I were to look at 3-4 years, because even the size of the opportunity is very large, do you think it will accelerate, it will stay here, or what's going to be the broader strategy?
So this is based on the current business which we have taken on. We now look at commercializing all of that business with the capex which we have done, and then review what capex we will do for FY23-24 onwards.
Okay. But whatever capex you are putting will be fully, you are expecting it to get fully utilized in 23 itself?
Yeah. So once we set up the capex, we have businesses which have been tied up. So all the capex which we are currently doing is based on business which has been tied up. And
got it.
It would be commercialized based on the timelines which we have in terms of product commercialization.
Got it. And so our general, do you think any improvement in the working capital will happen, or this is the level we will continue to see?
So working capital, you have seen some improvement between say Q1 to Q3. In Q1, we had a higher level of working capital, which was abnormal. As we move forward, we will see some more improvement. And as the scale increases, you will see further improvement next year.
So what is the, like your internal target level of, working capital, you would like to keep?
We internally look at a net working capital somewhere between a 75 and a 90 days.
You always had, in that sense, cash conversion of roughly about 70 days, right?
Right. So that's what we would look at.
Obviously, that's a lot of range to assume.
Yes.
Thank you, sir.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1. The next question is from the line of Amit Shah from Ace Equity. Please go ahead.
Hello. Hi, sir. So I have two questions. First would be any progress on our UK subsidiary?
I mean, we've set it up. We're just in the process of sorting out the logistics for the subsidiary. But until travel resumes, there will not be much activity at the moment.
Okay. Okay. And sir, in auto side, there hasn't been any new orders except Honeywell from last few quarters. So can you discuss a little bit about that segment?
We don't actively participate in automotive, neither actively pursue business. We're doing just niche business on particularly where there is metal to plastic conversion or high requirement of engineering. But apart from that, we don't really actively pursue that business.
Okay. Okay, sir. Thank you.
Thank you. The next question is from the line of Atul Kothari from Progwell Securities. Please go ahead.
So thank you for the opportunity. Sir, I have two questions related to the toys business vertical of us. So, sir, I wanted to know as to the new order which you have received for the toy business. Is it from the Spring Master or from some other client?
It's from another client.
Okay. So which client it is?
We will name the client once we start supply.
Okay. We cannot, I'm sorry, but we will not be able to name the client.
Okay, sir. Okay. And sir, since we are getting business from renowned toy players as a result of this strategy of shift of business from China, okay, from some of our clients. So we'll be supplying existing products, or this will be new category of toys which will be supplying to them?
Some are existing products that are already available on the market. Some will be new launches.
Okay, sir. So, sir, what will be the percentage, or can you just give me a product mix in terms of new and existing? Would it be 50-50, or it will be more in favor of new toys?
So I think this business is still evolving.
If we look
currently it's a split between 50-50.
Yeah, probably even more on the new side.
Yeah, it's a split between 50-50.
Okay, sir. Okay. And sir, what type of toys are you manufacturing? Can you throw some light on that?
These are complex games, puzzles, electronics.
Okay.
Play sets.
Okay, sir. Thank you, sir. That's all from my end. Thank you.
Thank you very much.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1 now. Participants who wishes to ask a question may press star and 1. The next question is from the line of Vandana Soni from SBI Capital. Please go ahead.
Thanks for the opportunity. Just wanted to understand, is there any decline in domestic sales this quarter? I believe domestic business is primarily FMCG and CRT caps. Are you seeing any slowdown in these businesses?
No, in fact, our FMCG business is doing exceptionally well. In whatever products and markets that we participate, we have an increased order book.
So, Vandana, even if you were to look at domestic business, it's not only FMCG and CRT caps. Part of our device business is also domestic because we supply to some companies in India and they in turn export it out. So for us, it's domestic business. Some of our auto business is also domestic. So we have domestic business across different segments.
So what led this decline in this quarter?
It is not declining.
It's not declining.
Okay, Okay, my second question is on MEIS benefit. I just wanted to understand, it used to be around 4% earlier, what it is now, and how much impact it will be on the overall sales.
So MEIS, government came up with regulations in August capping MEIS for September to December at 2 crores. So our MES income which we have recognized in our books has been capped at that level. And we have foregone the balance MES benefit. And that impact is about 1% of the revenue for quarter 3.
Let me rephrase that. We've not booked the MEIS benefit, but we don't intend to forego if there is a way.
If government allows it, we will take it.
Exactly. Yeah. So, but at the moment, we have not taken it on our P&L.
Okay, understood. So if I may ask one more question, I just wanted to understand what are the key raw materials and from where they are sourced.
Sorry,
So, what is the breakup of imports, or how much percentage of your sourcing from India?
So 50% of our raw material is imported, 50% is domestically sourced.
Okay. Understood. So, if you can give us how much inflation you are, I understand you have passing contracts with all the customers. So, how much inflation is there for raw material?
Vandana, your price increases on raw material. I think that's the question.
Yes.
It's from material to material. I mean, in some cases, we're talking about maybe 8, 10, 12%. There are materials where it has gone as high as 100, 105, 120% also.
Okay. I just wanted to understand, so how much, this quarter you have seen there was a gross margin impact due to raw material prices. So, next quarter will be, gross margin will be benefited with this, right? Only 3 months gap.
That depends on material pricing.
Okay.
It's a combination of material price movement and volume that we sell every quarter. Sometimes we get a little bit more, sometimes we get a little bit less. It balances out at the end of the year.
Okay, understood. Thanks. That's all from my side.
Thank you.
Thank you. The next question is from the line of Pritesh Chheda from Lucky Investment Managers. Please go ahead.
Yeah, hello team. I have one question. Based on the supply commitments that we have for different projects in the next year, I just wanted to understand if you could help us tell a broader revenue number which is possible on the supply commitments, one X of the steel project, steel furniture, and one including the steel furniture, if you are willing to share a certain range of revenue.
All right. So I think without the steel furniture, we would be looking at somewhere between 500 and 550. And with the steel furniture, somewhere between 550 and 600, or 620.
Okay, so without steel furniture, it's 500 to 550, and with steel furniture, it is 550
to 620.
550 to 620. Okay. And I missed one question, answer one of the question which was asked by a participant about the gross margin and the EBITDA margin, not expanding to an extent which you would have thought otherwise in the quarter. I could understand the response with Mr. Shah gave actually.
If you were to look at quarter 3, there were two impacts which happened in quarter 3. One is the capping of MEIS basically led to a 1% drop in the EBITDA. And we commercialized carbon steel. So carbon steel at a net level in quarter 3 was negative on EBITDA. So these were two reasons why you are seeing EBITDA, which actually could have been higher, was a lower percentage.
Okay. And has the full depreciation on the carbon steel project started flowing in this quarter, or it was partly operational in the quarter?
So it's been partly operational. So you will see the full impact of it in quarter 4.
In quarter 4. And what is the depreciation run rate on the invested amounts? I think we invested about 50 crores as capex in steel furniture, right?
Yeah, about 55 crores.
And what rate would you depreciate that asset?
It will be different for different assets, different group of assets. So my guess is if you want to look at it, you would probably look at a 15-year effective life of the asset.
Okay. Thank you and all the best to you, gentlemen.
Thanks, Pritesh.
Thank you.
Thank you. The next question is from the line of Sunil Jain from Nirmal Bang Securities. Please go ahead.
Yeah, congratulations on good numbers, sir. Sorry if I am repetitive, I just missed the opening remark. So, new order which you won in this quarter, can you repeat it or can you quantify it?
Sure. We added it in, we were awarded 120 crores from the home furnishing business. We added another product on the toy side where the value is $1.5 million per year. And we also developed another novel intellectual property for a pet injector.
Okay. So, this 120 crore include that 1.5 million toy also?
No, 120 crores is on home furnishings and
Okay.
the 1.5 million is on toys.
Okay, fine. And sir, about the MIS, though we lost around 1% of revenue in Q1, but how it is going to play out in the coming period?
So we are waiting for the ROT-DEP rates to be notified. And once the ROT-DEP rates get notified, we will have clarity in terms of how it will work out or pan out in the future.
So this 2 crore limit is still continuing in Q4 or no?
No, so MES as a scheme is not there post 1st of January 21.
Yeah. So whatever the scheme comes, then according to that, we may get something.
The scheme is ROT-DEP, which is refund of duties, but the rates have not been notified by the government, and the rates would be notified by the government as we move forward.
Okay, so will it be from 1st Jan or that is also uncertain?
So the scheme has been launched out from 1st of Jan, but the rates have not been notified. So once the rates get notified, we will have clarity in terms of what the rates are.
Okay, fine. And yeah, you had given next year's revenue expectations and all, but any long-term visions like what you had shared earlier, is there any thinking on that line or will be coming back later?
So let's first get the numbers which we have talked about, and then we would probably talk about the long-term vision.
Okay, great. No problem. Thank you very much and all the best, sir.
Thank you.
Thank you. The next question is from the line of Nirmal Shah from Seraphic Management. Please go ahead.
Yeah, good afternoon, sir. Just wanted to check two things. One, with respect to MEIS, now under the new regime, since the rates are not notified and you would be actually executing those orders, so and in event if the rates are lower than what it was in MEIS, will there be a margin hit? Means how are you actually tackling this?
I mean, there isn't a way to tackle it. If the rates are lower, then it has an impact on the gross margins and the EBITDA. However, we are expanding our business to negate that impact and increase the performance, bottom line performance.
Okay. And sir, second question was because of this container shortage, was there if you can just quantify amount of revenues, if at all, you were supposed to book in December quarter, but you couldn't book because there was a shortage of containers. Is it a significant amount or was it a very minimal? If you can just highlight that.
Like, I mentioned in, I think, one of the answers, what we have been able to manage logistics, even if they have been delays, but within the quarter, we have made all the shipments we were supposed to.
Okay. And so the third part was with respect to the raw material price inflation. Is it fair to assume that the real raw material inflation would be actually reflected in the fourth quarter results? Because in the third quarter, you would have probably some cushion of the low price inventory or something, or is it not the case? And actually, Q4 would be a fair reflection of your margins and the raw material prices prevalent right now?
Raw material is always it's a moving target. So with the 1 month lag, if previous 3 months, if everything we ordered in the month of November and December that we will use in January and February, for example, has been higher priced, then you will have a negative impact, which will get recovered in the following quarter. If everything we ordered was a lower price than the previous 3 months, then you'll have a positive impact.
Okay. So just holistically, I'm just trying to, if I look at the trajectory of the margins, not from a long term, but from a short term perspective, if at all, again, these are hypothetical assumptions, if at all there is some negative, news on incentives where the rates are lower than what you have projected, and on the other side, you also have a pressure of passing the raw material to your clients, means it's a pass through. But do you think that in such an event, it would be so easy to pass through, or will it take a little bit more time than usual to pass through that impact, if at all it happens?
So raw material is a straight pass through. It's an agreed process. So
right.
Irrespective of whatever changes are there, that will be a straight pass through.
Right. And about the incentives, sir, if at all, if it lower than what your assumptions are, will it be again a 1 quarter lag, or it will take some more time?
Let's wait for the new rates to get notified, and then we will be able to comment on that. I think it will not be possible.
But the answer is that, if there is even if the rates go down to zero, this is not something we'll be able to pass through to the customer. I mean, customers are not doing business with us because the government's giving incentives.
Right.
So
no, I respect that, sir. I just wanted to little bit be more clear about the time lag you require to come back.
As the business grows, even if there's no schemes in place, our margins will improve.
Okay. Thank you.
Thank you. The next question is from the line of Manish Gupta from Solidarity. Please go ahead.
Amit and team, congratulations on very good progress. If you look at your revenue run rate, that's give or take about 100 crores a quarter, and you're guiding for a lower bound of about 560 crores next year, right? So even if you just annualize that, that's about 140 crores give or take per quarter. Now, historically, you have really been challenged by availability of labor, and this is a very, very steep ramp. And, you could be actually exiting the year at much higher than, 140 crores per quarter. So, given that a lot of our business is fairly linear as far as labor is concerned, how are we gearing up for such a steep increase in labor force to be able to execute on these numbers? Some perspective on this will be very useful. Thanks.
I will maybe answer this very briefly and then allow Mr. Kalra to shed some light on it. As he has come on board, we have been able to resolve our operational challenges fairly well in almost all of our plants. The efficiencies are up, our OEEs are up, our labor downtime is reduced. So, that momentum will continue in the existing facilities. Second, the additional revenue that is going to come in next year, a significant part of it will come in from the new facility that is being set up in Halol. Now, in general, we have operated in Halol for 32 years, and that is one location where we do not have any labor issues. It is a workforce that is motivated. It is a workforce that needs to earn, because there isn't farm income in that region. So we do not anticipate problems in the new facility over there. Over and above that, the way the facility is planned, there is a very, very, very high level of automation in that plant. We actually will not have any contractual workers in the new facility. They will either be, all of them will be permanently on our payroll, but the number that we require will be far less than what we currently operate with. Mr. Kalgan, to you.
Yeah, the existing facility at Rania has seen improvement in terms of efficiency. While Sanjay Bhai presented capacity improvement by 5%, actually the OE went up by more than 10% because there was a very high improvement on the efficiencies. That means the downtime and all on account of machine breakdown, mold breakdown, or manpower not available or whatever. So all that has been overcome, and we were able to bring down the loss of sales due to no manpower from 8% to 1% in the second quarter itself. So that has been sustained after that. So manpower is not an issue at Rania also. And, there has been a lot of awareness being brought to the workforce so that they understand the company's requirement and they work towards that. Now, in the new projects, Halol is a place this company is quite used to, and carbon steel is a new project, so we are very careful while hiring in the carbon steel. Carbon steel manpower cost should not be equivalent of the plastics. It should be lower because the processes are mostly progressive types of tooling in the mechanical presses, and also conveyorized semi-automated, automated border coating. So that manpower, we are very careful in hiring the best of people, either a diploma in mechanical or the relevant technology, and also minimum ITI workforce. And Halol does not have the kind of challenges of workforce that we had in Rania. So carbon steel, we should stabilize, as I said, by March, April, and that should bring down or contain the manpower cost to sales. The new facility, as Amit has also mentioned, the plastic facility that we are setting up, we should commercialize by June 21. The idea is to have no light facility. So actually, robots do their job and some kind of supervision and some engineers. So that's the project, there's a theme that this plant is being set up on. So it should drastically bring down the dependence of contractual manpower. If we hire some, those would be from plastic institutes like SHEP and all. So that should strengthen the skill level and the outputs. So I hope I made myself quite clear.
Yes, thank you. Just a follow-on question. Your margins are also sensitive to product mix where healthcare and pharma is higher margin. But now over time, as you're growing and we are expecting a lot of efficiency in labor, over the next 5 years, could there be margin expansion just in the base business because of these labor efficiencies, or will this labor efficiency be compensated by higher employee costs because we're just hiring people of a higher quality talent?
A bit of both is going to happen. We are going to see operational improvements. So we will see margin enhancement because of bringing down labor costs. And I mean labor which works on the shop floor. We will see an increase or we will see some reverse impact on account of hiring better talents. And we will need this talent for the growth that we have planned. I mean, at the moment, I think a lot of us are focused on the next financial year delivering the number that I mentioned a few minutes ago. But beyond that, the company is going to grow. And for us to gear up for that growth, there will be a lot of hiring that takes place at mid-level and senior level. And that will contribute to, negating some of the margin improvements that would potentially come in.
So, Amit, if we put it all together, over a rolling 5-year period, I mean, you're already close to 18% EBITDA margin. do you think, FY25 kind of time frame, these margins could be approximately 20 or higher at an EBITDA level?
Yes.
Okay, excellent. Amit, just one last point. I think it'll be great at some point in time just to have an investor day where you can talk about your, rolling 5-year plan. Obviously, you have a lot on your plate right now, but it'll be good to pencil this in at some point in time, whenever you guys have time. But, for investors who are more keen on longer-term horizons, it'll just be good to get some sense of the roadmap you guys are working with.
Absolutely, Manish. We'll have Sanjay or SGA come back to you with once we've frozen our plans. But well noted.
Excellent. And once again, congratulations on remarkable progress.
Thank you.
Thank you. The next question is from the line of Aman Beach from Astute Investment. Please go ahead.
Good morning, sir. My first set of questions is on the home furnishing business. So this 120 crore additional order, does it include the carbon steel business as well?
No.
Okay. And is this the regular order which we keep getting every few quarters, or is it a totally new set of products which we are talking about?
It's a new product which we are adding.
Yeah, additional.
So apart from the base business, this is on top of that?
Yes.
Sure, sir. My second set of questions is on the toys business. So this 70 crore capex we are doing, is it only for toys, or what percentage is for the toy segment?
No, so the 70 crore capex is for toys and the new plastic factory which we are setting up in Halol. It's for both of them.
Okay, and roughly what is, say, dedicated for the toy segment?
It will be around 20 crores.
Okay, sir. And till now, what is the total capex we have done in the toys division?
Till then, we have not done many major investments in the toy division. It's been mainly some decoration facilities and everything. What we're doing right now is about 20 crores, where we are adding molding machines and adding some assembly lines and things like that. So.
Sure, sir. And any plans next year if we plan to do, because now we have gotten 2-3 customers and then scaling has also started happening, a dedicated plant or something for toys business?
So once we execute this order and then we see the pipeline, we'll see how we want to go about it. Dedicated factory for toys. This is his question.
Sure, sir. My final question is on the carbon steel business. So, sir had talked about we will be commercializing 3 out of the 5 products. This is by the end of financial year or calendar year of FY21?
So the third article should get commercialized by April or so, the first month or the first quarter. So we'll have 3 articles and duly productionized, commercialized. Okay. And then the fourth we would also
2 variants to that range. So all in all, 4 articles will get commercialized by April. And then additional 2 should happen in June.
Yeah. So total of 6 by June.
Yes.
Sure, sir. And has this number increased over the last 1-2 quarters, or is it the same initial commitments that we have gotten from the client, this number of articles?
This is based on whatever we talked about in terms of additional business being taken in quarter 1 and quarter 2. So it includes that.
So my question was actually, was this the initial commitment at the time of the capex, or this is like in the last 2 quarters only they have decided, okay, you can get this extra additional orders also?
No, this is all these 6 products are part of the initial basket.
Sure, and there is opportunity to scale or enter into newer products as well in the next 1-2 years?
Once we showcase some, at least 6 months of solid performance, we will have plenty of opportunity.
Sure, sir. And any idea what is the export out of India of this segment, particularly to the home furnishing segment, just to understand how big is the industry, carbon steel home furnishing segment?
I really, unfortunately, do not have the answer to that. I know the ticket size or the buy that the home furnishing major would have is probably in excess of 1.2 billion euros. So, and India will be a very small part of that at the moment.
And majority of this will be for Chinese as of now, or is it developed geographies only?
No, I think globally steel furniture is mostly sourced from China. You also have some players in maybe less than a handful in Europe and then some big names in North America and the US. But most supplies are out of China.
Sure, sir. So as of now, it is a replacement of a China plus one strategy for us?
No. This started way before that. This initiative started in 2017.
Initial discussion started.
Yeah. So this has nothing to do with the China plus one strategy.
Okay. But we might be getting benefits because of that now.
No. China's raw material costs are far lower than India when it comes to steel.
Okay. So, what is our competitive advantage then, say, vis-a-vis the Chinese player?
Obviously, we see benefit out of labor, but more than anything, the businesses we develop don't really work so much on just whether there is a cost advantage or not. Even if the cost is on par with China, it is about risk, it's about relationship, it's about consistent performance, and it's about what you bring to the table in addition to price.
Sure. Thanks for the clarification. Thank you.
Thank you. The next question is from the line of Ritesh Shah from Investec. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations for a good set of numbers. My first question is for Sanjay Bhai. Sanjay Bhai, what are the MEIS rates that we were on, and what will be the threshold that we would be looking at for the RODTEP scheme? Thanks.
So we have different rates for different products, and at least from what we have looked at in the past, the RODTEP rates, wherever MEIS rates they've been notified, and the RODTEP rates have been more or less in line with the MEIS rates or higher than the MEIS rates for textiles or other sectors which have come in. So our expectation is that the RODTEP rates, once they get notified, would be similar to the MEIS rates, but we will have to take a call once the RODTEP rates come in.
Would there be a broad ballpark number on MEIS number at company level from a P&L standpoint?
Yeah, there will be. So that would be there in the numbers which we report out. So yes, there would be a number which would be there.
So Sanjay, I did check in the annual report under other assets. I figure out the balances from government authorities. That number is there, but nowhere do I find it on the P&L. So if you can help quantify it post call, that would also be useful, sir.
I'll get back to you on that, Ritesh. No problem.
Great. My second and third question is for Amit. Any update on UK subsidiary? And secondly, can you detail more on the pipeline for the pharma business? Thank you so much.
So we have upcoming supplies to be made to customers for their registration batches in the month of March for a particular molecule. What I mentioned in the speech was that we've developed an additional pen injector and the IP for it. We will be developing both the new pen injector as well as auto injector, which we actually started development, I'd say two quarters ago. One of the things I'd mentioned in I think February of 2020, March or February 2020, our earnings call had mentioned that we're going to go ahead with development of a new auto injector. So that is in the pipeline. Auto injector is a very complex product. It's going to take longer than what we would do on the pen injector. But at the end of FY22, we should have 3 additional platforms commercialized and being sold to customers. From a revenue perspective, what you see between now and 24 is going to be one, increase of our contract manufacturing businesses, in addition to variance there. Second, you'll see revenue coming in from registration batch supplies that we do to various customers on the platforms that we have. But the real scale up you will see 24 onwards when these registration batches are then have approval to be sold commercially in the market. So our customers will start the process of ramp up and launch from 24, 25, 26, 27. There's different dates for different molecules when the original patents expire. And therefore we would see gradual ramp up or very significant ramp up after 24. But I anticipate 5-year, 3x at least.
Thank you. The next question is from the line of Abhishek Gupta from ADB. Please go ahead. Mr. Gupta, may we request you to please go ahead with the question? Mr. Gupta, may we request you to please unmute your line if muted from your handset? As there is no response, we'll move to the next question, which is from the line of Hitesh Tong from ICICI Direct. Please go ahead.
Thank you for the opportunity again, sir. Sir, I just wanted to know one thing. We are very positive on the product. Sir, could you just tell me, what are there are around 2 to 3 customers of in that segment, if I'm right. So what is the revenue of those 3 guys put together? If you can throw some light, sir.
Hitesh, could you please repeat the question?
Sir, I just wanted to know that the 2 or 3 customers what we have in our toy segment, what is the total revenue of those 3 customers, sir?
So what I can tell you, Hitesh, is the customers which we have are among the top 5 toy companies globally.
Okay. But any revenue, their revenue top line idea, sir, if you have any?
No, we have that, but as I said, if I give you the revenue numbers, you'll know which these companies are. We have named one company. The other company, we are not able to name it right now. We will name it once we start supplying, and not actually one of them. Yeah.
Okay.
So.
Okay, sir. And sir, my next question, a bit of bookkeeping question, sir. What is the current, current quarter, sir, cash flow from operation? If you can give, sir, for YTD number.
Cash flow from operations has been given in the presentation which we have. So our cash accruals are about 12.8 crores for the current quarter.
Okay. Is this a cash flow from operation, right, sir?
So it's cash accruals which I'm talking.
Okay, got it. And sir, what is the gross debt position at present time, 9 months?
Total debt to equity is about 1.5.
1.5. 9 months, right, sir?
9 months, yeah.
Sir, on absolute amount terms, sir, what is the gross debt, if you can?
I'll get back to you with a number.
So we are, kind of doing a future capex, as you have given a guidance of around 70-80 crores. So, and that would be with a mix of internal and debt. So, I just wanted to know, our debt position is likely to remain going forward, or would you like to be, would you like to be reduced? I mean, I know that would be a bit early to say, but if anything you would like to share, like about that current debt position.
So on the debt position, as I mentioned, the capex which we are doing will be financed by a mix of debt and internal cash accruals. The debt is already debt which has been sanctioned, which has not been drawn, which will be drawn. Part of it has been drawn in December, but the balance will be drawn in the current quarter, and that's what we will spend on capex. So that's what we are looking at, and the balance will be internal cash accruals. So internal cash accruals which the company has generated in FY19, FY20, and projected FY21 is what they will basically use towards the balance of the capex for the year. Do you want to just do that?
Okay, sir. That's all from my side. Thank you.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for today. I would now like to hand the conference over to the management for closing comments.
Thank you everyone for joining on the call. We hope we've been able to answer your questions adequately. For any further information, I request you to get in touch with SGA, our investor relations advisor. Thank you very much, and season's greetings to all. Stay safe.
Thank you. On